Hi, I'm Rick Kahler, and thanks for joining me today. Well, those who are the hardest hit by the market losses of the last few months are basically retirees. For many investors, there's time to recover from these losses. In 5 or 10 or 15 years, the markets should have come back, and their nest eggs should have regained their value. Those counting on their nest eggs for today's omelets, they don't have that kind of time. For them, losing 25 or 35% of their investments isn't a matter for the future. It's a frightening reduction in the source of their current income. What we're seeing right now, in unpleasantly dramatic fashion, is the strongest argument anyone could make for being conservative in the amount you withdraw from your investments in retirement. If retirement accounts, IRAs, and taxable investments will make up the bulk of your retirement paycheck, it's wise for you to make your retirement plans based on a conservative withdrawal rate. If at all possible, you should provide for your essential needs with no more than a 4% withdrawal rate. That means if you had $1 million, you should withdraw no more than $40,000 a year for your retirement income. Now, some advisors are comfortable with a 5 or 6% withdrawal rate. Well, in my opinion, this is really pushing your luck. You always want to plan to withdraw less than the average amount you'd expect your portfolio to earn. Since 6 to 8% is a reasonable average to expect over the long term, withdrawing 5 or 6% is not necessarily going to be sustainable. Now, some advisors are even more optimistic. A company whose software I use estimates a 14% annual return on its most aggressive portfolio and a 9% return on its most conservative. I stopped using this company's retirement projections years ago. Instead, I estimate my most aggressive portfolio at 7.5 to 7.75%. And my most conservative is around 6. Now, even worse, Dave Ramsey, a well-known radio personality, has long recommended an 8% withdrawal rate. He talks about expecting good growth mutual funds to return 12 to 15% a year, a rate of return not supported by the statistics during the past 10 years. Ramsey's excellent program has helped numerous people get out of debt, but that doesn't necessarily mean his investment advice is the best way to go. Now consider this. Suppose that you had retired 10 years ago with $500,000. Had you followed Ramsey's advice, investing in a good growth mutual fund, and withdrawing 8% a year, or $40,000, you would have run out of money in November of 2008. In South Dakota terms, you'd be dead broke. Now, had you followed the conventional wisdom of every reputable financial planner and investment advisor I know and withdrawn 4% a year, or $20,000, you would still have $156,433. But even that is a little frightening. I don't think investing all your money in one asset class, like good growth mutual funds, is a good idea at all. That is really going against the proverbial wisdom of not putting all your eggs in one basket. Personally, I prefer a diversified portfolio of different asset classes. Now, an asset class is U.S. stocks, international stocks, bonds, Treasury inflation protected securities, real estate, cash, market neutral funds, and even commodities. Now, had you invested your $500,000 in a well-rounded portfolio with all those asset classes and withdrawn $20,000 a year over the past 10 years, today you would have $556,341, even with the recent market losses. That's pretty remarkable. It's actually more than remarkable. It could be the difference of literal financial life and death. It's foolish to plan your retirement around projections that are unreasonably rosy. Positive thinking is all well and good, but counting on unrealistically high returns or withdrawal rates is taking optimism way too far. When it comes to your retirement income, it's better to be pleasantly surprised and a pessimist rather than a dead broke optimist. Thanks for joining me.